Welcome back to another episode of Profitless on Purpose. I'm one of your hosts, AJ Wheeler. With me this week, as always, and for 50 episodes now, is Mark Palardy.
Hey, everyone.
50 episodes, our 50th episode. Exciting. I can't believe we made it this far. Here's the 50 more. But got a great show for this week, as always. We have a couple articles, how to think about your fundraising investment. How much should you be investing in your fundraising arm of your nonprofit? What that return on that investment should look like? What your fundraising arm should really be thinking about when it wants to increase its reach, increase its return, increase the donations coming in. We'll talk about all that. Mark, I'm sure, has a few disagreements with that article, as always, if you've listened to any of the 50 episodes before this. Then we have an article about how a nonprofit raised growth capital from public markets, essentially initial public offering from a nonprofit. Although it sounds a little bit different. People aren't investing or owning a piece of that nonprofit. They're investing in debt. We'll talk about how TechSoup was able to do that, one of our favorite nonprofits to talk about, and how they went about raising capital from a public market and what it meant for them and how you can think about it for your medium or small size nonprofit. And then we have an article, The Racial Politics of Solidarity with Ukraine. What does it mean to support the Ukrainian cause right now? How does that reflect on your nonprofit? Should you think about, how you publicly support different causes for your nonprofit? We'll talk about kind of that murky water of how to throw your support behind something and if you should, and just the backlash expected, even if you think you're doing a good thing here. And then our topic for the week is how nonprofits should diversify their revenue source. How diverse should it be? What does diversity in your revenue streams actually mean? What's considered an overconcentration of revenue sources? And how to be thinking or aiming for diversification of your revenue streams in your nonprofit and how to plan for it. We'll talk about all that and more this week. Anyway, Mark, you have our first article for us. Take it away.
Yeah, AJ, first off, big 5-0. It's hard to believe, huh, man? We made it. We made it to half a century of podcasts. That's unbelievable. But now we just continue on the next 50, right? So first article today is How to Think About Your Fundraising Investment by Benjamin Domingue. And basically, this gentleman is presenting nonprofit as kind of as a for-profit and talking about how you can think about your investments in your nonprofits in a less of a nonprofit way. So he had previously in a previous article posited that nonprofits would do well to see their development department as a profit center rather than as a cost center. So fundraising expenses are seen as investments instead that will increase your revenue as opposed to the normal quote unquote way that one usually sees the development department, which is, as something that's costing you money on a functional expense report. It's going to be broken out as to what your fundraising expenses are. And there's lots of people who look to see how much money you're spending in order to raise money. He is positing a different kind of theory on this, basically saying you limit your investment in the development department at your own peril. And a lot of nonprofit companies are asking, how much should I invest in fundraising? And often the answer that they're given is as little as possible, right? You want to be able to get the biggest bang for your buck with as little investment in fundraising as possible. And he basically turns this on his head and says, no, you actually should spend more than you think you need, and you should use that to help grow your nonprofit. So I think there's two tracks that he's wanting to go down. He's talking about if your nonprofit just wants to stay the same size that it is, then you can basically keep your spending about where it's at and maybe even reduce it a little. But if you want to grow your nonprofit, then you're going to need to have more of an investment in this fundraising expenditure. So this makes sense if you think about it like in terms of a capital campaign, where if you're trying to raise some money to grow your organization and you're thinking outside of the normal operations and you're trying to say build a new building or do some project that's going to enhance and add to your nonprofit, then you're going to need to actually get the word out there that you're raising funds for this, and this is going to cost some revenue spend, this is going to cost some development spend to actually get your name out in front of more people and figure out what it is. And he has a structure of how you go about doing this with revenue goals and, considering percentages of spends. And his underlying theory is that significant fundraising expenses are unproblematic completely. They are completely responsible if your goals are to grow and to assure that your growth is sustainable. So that's his read. I have some thoughts about this, but AJ, I'm going to let you chime in first as to what you think about this.
Sure. I mean, I kind of so I've been thinking a lot about this lately, and I think it comes, and it's hard to get away from, talking about how much you're spending on fundraising arm of your organization if you're not talking about, essentially how you're budgeting for this stuff. So one of the things I think that nonprofits think about when they set up a budget or, like cost centers, of course, programmatic expenses, are usually really, the main focus of how a nonprofit operates and where they put a lot of time and effort into their budgets, less so when you're talking about an administrative budget, which I think fundraising would fall into. If you're savvy enough to have, not just an administrative budget and, and also have like a fundraising budget as well, I would think, this makes more sense. The problem I think that I found is that it's not broken down any further than that. You just have this executive, everybody thinks of that 10% overhead, how can we run the business in this sense? But what he's really saying, and what I don't think is mentioned in the article, is I would look more at like your return on investment. I mean, you could throw a lot of money at the fundraising, in your fundraising efforts and not receive anything back for it. So you wouldn't be spending the money wisely. I think investing wisely in your fundraising, I would be much more apt to spend 33% more on fundraising this year if it brought in, if you can show me that money is being put to good use, So I think, just blindly throwing money at fundraising doesn't, you have to look at this on, a month to month, year to year, campaign to campaign kind of return on what you're spending. And I've been associated with nonprofits that put a lot of money into development department or into fundraising arm of their organization, and it's foolishly spent sometimes, and the return isn't there. You can get over that, I think, by maybe taking fundraising, I think, or development. I would think you need to have some kind of like educational piece of that where you're, it's almost like marketing and advertising is rolled into, if you're thinking about, like a for-profit business and you're talking about M&A, marketing and advertising, you could probably roll that same kind of thinking into fundraising where, okay, maybe it doesn't show up on the bottom line, but has there been more engagement? Do we have more volunteers? Because again, that's going to add to your bottom line in a different way that maybe doesn't show up in a profit and loss statement or a return on investment. But being able to like quantify your return, whether it be through, more community engagement, more people know who you are, in the long term, in a long run, would provide you with more donation dollars, one would think, and so the visibility of your nonprofit could be raised. But I guess just thinking about it from my perspective is, I would want to do a return on investment and have strategy set up, and a really savvy development department would want that as well, to be able to, essentially show their worth to the organization and justify the money that's being spent, to fund that arm of the nonprofit. Because let's be honest, if it's not being used correctly, it can be directed back to new programs. The thing that really matters in a nonprofit, the mission and the community that it serves. So I agree. A lot of what he says, I agree with. I think looking at a percentage of total overall revenue is acceptable, or budgeting based on an expected return and what that should look like, what that investment needs to be to bring in that type of money. And investing in the right kind of people. I mean, I think without the people power, without the right people power there, and without the correct sort of reach, you're just throwing money into a black hole saying you're fundraising. And we've talked about many times on this show, really being able to identify how profitable a gala is or a fundraising, campaign is, because anybody can just throw money at it and you'll get some kind of response. But, are you Greenpeace with those people that are paid $20 an hour that sit on the street corner and ask you to sign up for $5 a month, like annoying, and people get turned off to that. And a lot of that money doesn't even go to the nonprofit. It's there to pay for that person with a clipboard and the fundraising organization behind it. But if you're reaching out and educating the public and getting good engagement and good, volunteer engagement, like some kind of metrics, I guess, like crafting in your nonprofit some kind of metrics to show the reach and the return on that investment in the fundraising environment would be great. It's too bad you can't do that with an accounting department, right? We're just a sunk cost in the equation there, but you need us, and I think you need a development and a fundraising arm as well, because as we'll talk about later on in the podcast, it's great to diversify where those funds are coming from. So having an agile development department that knows what they're doing is, I think, vital in a nonprofit that's robust in their admin spending. So.
Yeah, I have two kind of fundamental issues with kind of the theory this guy is presenting. Sure, I can buy into some of what he's saying as far as, you got to spend money to make money or to bring money in. But I think AJ touched on one of them when he talked about really getting to your mission and vision and values, right? This article to me is written kind of with a tone of a capitalist, right? Like, grow your business for the sake of growing your business, and not necessarily we grow our nonprofit for the mission or to serve more people or to grow in a programmatic way. It's more like, well, I got to build this building because the nonprofit always has to keep growing. And I think, like AJ was mentioning, you want to be spending this money intelligently. You want to make sure you're getting the best bang for your buck and that you're serving people. There's nothing wrong with a nonprofit growing, but there's nothing wrong with a nonprofit staying the same size either. If they're serving the mission and they're serving the community that they want to serve, that's great. And, we don't need to be forced into this capitalistic mindset that every nonprofit needs to constantly be growing. So that's issue number one. Issue number two was that he ever so casually jettisons the idea of Charity Navigator, right? And so Charity Navigator is out there and they're looking at how much, one of their metrics to rate you your stars is to look at how much your fundraising expense is. And he kind of wants to dismiss this because the idea of you need to spend money to make money, et cetera. But at the same time, if I'm a donor, or if one of our listeners out there, if you're a donor and you're giving $1,000 to an organization and 33% of that is going into fundraising costs versus 10% going into fundraising costs or overhead, it's going to make a difference to you. At least it would to me, because I would want to make sure that my money is going and helping to affect more people and to serve a mission. And frankly, I would have an issue if I'm seeing these huge ballooning fundraising costs, because it just doesn't, if there's a purpose to it, if there's a capital campaign or something behind it that is serving the mission, I get it. But if it's just, we just want to keep spending more and more in the development department, it doesn't really, I can understand why Charity Navigator would want to release that information and have donors make the decision. I don't think you can just, throw Charity Navigator under the rug and say, this metric isn't really important, or you shouldn't pay attention to this. They don't get it. Well, a lot of people use Charity Navigator to figure out what they want to donate to. And if that's an important metric to them, then I think people should be aware of it. So,
well, and I think maybe too, Mark, I think looking at like, if you have a poor Charity Navigator score in that place, be ready to provide a reason why, right? Like, oh, we were in a capital campaign mode. Of course we had to spend more money, because Charity Navigator isn't going to give you that. And most donors aren't going to dig deep enough to see what that return and increased spending is, like, so yeah, I think being able to, yeah, there's no context to it, right? I guess.
Right. All right. Yeah. I mean, and I'm not an apologist for Charity Navigator. It's certainly got its issues, but I don't want to treat all nonprofits like for-profits either. So that's why we're here, right? We're profitless on purpose. Okay, AJ, you got our next article for us.
Yeah, deep one. Well, it's from our friends over at Stanford Social Innovation Review, SSIR. And if you followed the podcast, you'll know that these are a little bit of a deeper kind of dive and an academic look most of the time. And this one is titled "How a Nonprofit Raised Growth Capital from Public Markets." So this was interesting. We've mentioned on this show one of our favorite kind of nonprofit sites or nonprofits period is TechSoup. And if people aren't aware of what TechSoup is, it's a nonprofit that provides essentially grants. So if you need QuickBooks and you're a 501c3, you can apply essentially for what's a grant to get QuickBooks at a steeply discounted price for a year subscription through partnerships that TechSoup provides. But this article has nothing really to do, well, it has to do with TechSoup, but it doesn't really have anything to do with their nonprofit purpose. What it's referring to is they had to raise quite a bit of money. And in fact, I think to expand their reach, they wanted to expand their overall footprint of who they could help and how many people they could help and the kind of and the kind of reach that they wanted to have from where they were at. So what they realized was they needed to raise about $12 million or so. And the discussion started on how to do this. And what they came to was what they call raising inclusive capital. So essentially, it boils down to they initiated loans or debt. They were able to secure debt from private individuals and public investors. And essentially, it acted like an IPO, but it was for debt. And it's essentially a direct public offering. So I didn't even know this was available to nonprofits. And according to the article, it seems like it's the first time that a nonprofit's ever raised capital like this. But it very much kind of like is what an initial public offering would be for like a public company. So under the SEC, there's a few different ways to raise capital in this way that nonprofits could engage in if they wanted to. There's a crowdfunding state-by-state reporting requirement that was enabled as part of the Jobs Act Title II. And then there's Regulation A+ tiers 1 and 2 debt offerings as well through the SEC. Now, these are really complex debt offerings and they're lengthy to read. We'll have a link to the article, but I don't necessarily know that we need to go through all the ins and outs of these, but just be aware that it is regulated by the SEC and that's the way that they chose to go. And the way they chose to go was under these Regulation A+ tiers, and they listed a couple of reasons on why they went that route. It was easier with the Jobs Act exempt crowdfunding. You would have to register state by state and have state filings in each one of those states regarding the debt, the amount of debt that you were acquiring from individuals and investors and companies in this initial a direct public offering. And so that with the Regulation A+ tiers 1 and 2, they were able to secure that debt and have one source of filing, which happens to be the SEC. And so they went around this, they hired consultants and went through this, and they were actually able to raise quite a bit of money and they reached their goal. And essentially, the article lists the lessons that they learned along the way. And the lessons that they learned was, the following. So there was a long lead time and unanticipated costs associated with this. Surprise, surprise, something a nonprofit has never done. Took a long time and cost quite a bit of money, and there was unanticipated costs. What those were actually because you're doing this through an SEC program, it made the nonprofit fall under having to have a peekaboo audit and essentially changing how their financial records were presented and submitted. They essentially fell under almost like what a public company would do that was traded on the stock exchange. So the And they also mentioned that since they've done this, there's been some changes and state-specific offerings around the regulation crowdfunding. And so it may be a better option now if a nonprofit is looking to do this. But what the other lesson, the further lessons that they learned was the value of value-aligned partners. Because this was so unique and because of the massive size of this kind of investment, they hired from, consultants that had some kind of knowledge in this area and individual investors, and they wouldn't have been able to do it without them. You're talking about a very unique offering, and they needed the expertise to pull it off. So the partners that they, either consultant wise or from even the individual investors that cheerleaded their corner and were able to essentially grant them more, was paramount in them being able to do this. Investor education. I mean, we've talked a lot about on this podcast, but being able to educate investors in this case, or donors in another case, if they're just handing over a check, to what they're donating to, how this debt offering actually works, and what their need was. And so being able to educate investors, both individual investors and institutional investors, at the different levels that they were offering of this debt servicing, essentially, was paramount. And then the fundraising strategies, being able to stakeholder relations, what other NPOs that were related to the financial investment, like investing clubs or individual investors or institutional investors. So I think the article is really interesting to read if you're, into this kind of thing. But I think the takeaway, because this is such a large, unique kind of vision of how you would raise funds for your nonprofit, is something to think about for our viewers, maybe that are at smaller nonprofits or mid-sized nonprofits. Is the takeaways that I found from this was, think about debt as part of your funding solution. What that means is you need to plan to be able to pay off that debt. So whether that's, purchasing a mortgage on a property, or taking out a line of credit, or having some kind of bridge funding, and being able to sketch that out for refunding. It also made me think about, debt being a way for a nonprofit to raise capital. It doesn't always have to be a one-way gift in a capital campaign. You might be able to receive those funds that you need now and be able to pay over time from individual investors that would, take a note on for a nonprofit. Now, of course, you would need to engage with your accountant, a CPA, a financial advisor that would understand how to set these up, a lawyer, being able to make those promissory notes legal and binding, and what the ramification is, because you're not talking about ownership in a company here. You're talking about financing a nonprofit expenditure or a nonprofit's growth through debt. So it's very different from if you were investing in Bob's Hardware or something and providing them a private loan. And I think at the end of all of this is, and we've said this before, if you're going to do something that's out of the box like this, or make debt part of your funding solution, is to make sure to engage professionals that are aware of the regulatory and fundraising process, and making sure that you have lawyers and accountants and, investment people that are on your side and in your corner, that understand the ins and outs of this stuff. Because unless you're a very savvy and well-rounded and funded nonprofit, it's unlikely that your accounting professional in-house would have the kind of expertise to pull something like this off. So, Mark, I thought it was an interesting article. I know it's a little dense and maybe outside of the norm of what, our nonprofits that might listen to this podcast would think of, but I thought it was interesting, and it made me think, outside the box on raising funds and using debt as part of your funding source.
Yeah, very true, AJ. Well presented, by the way. But I think debt is not something we often think about in the nonprofit world. Obviously people in a nonprofit can go into debt, when they're buying a building or purchasing these large things, but we don't think of debt as a funding source. And when I was reading this article, it reminded me, I don't know if you know the nonprofit Kiva, but Kiva is this nonprofit that's based in third world countries, where essentially you as a donor make microloans to people so that they can start their own shops, etc. And so basically, you're giving $50, but that $50 in India can help somebody set up a stall and sell something, and then you're getting a minuscule amount of interest back on that, and then you can use that interest to roll over into another Kiva loan, et cetera. So it teaches people how to be responsible and have debt, and then at the same time it can grow upon itself. So I've always I know about that model, but I haven't really thought about it for any larger scale nonprofit, which is kind of what this does. And one of the things I thought was interesting about this, because I have a mortgage background, and just listening to or reading about, they could take donations as low as $50, right? And for these $50 donations, you would get a 2% return. Then if you gave like $1,500, you get a 3% return. And then larger gifts, you get a little higher return, which I could just imagine if I'm trying to raise $1 million, $50 at a time, the servicing nightmare on the other side. You're going to have to hire somebody, because how are you going to pay out everybody these small amounts of interest? 2% on $50 ain't a hell of a lot of money, but you're having to make these debt servicing agreements to get this. I mean, this is where your cost base comes in. So you have to determine what makes sense, what kind of monetary amounts you're going to accept. Are you going to have $1,000 threshold on these things? How much are you actually trying to raise? Is this an ongoing thing? The other piece that I think of is, with the PPP loans that have recently happened, and the EIDL loans that came about because of the pandemic, there were quite a few nonprofits that I was interfacing with that were like, well, hell, I'll take extra money from this EIDL loan because I only have to, it's like 1% interest from the federal government to pay it back. Even if I don't use it and it's just sitting there as a reserve, having 1% to pay on that until we feel comfortable, that cushion really was, the price was right for that, for some nonprofits that I saw. So, there are ways to think about debt. And I think this is a fascinating way that TechSoup, created almost this securities situation to create debt. But it's something to consider, especially if you have a plan, a budget, a goal, and a way to eventually pay that debt back, because you don't want to be in debt forever. But it can be used to help grow and sustain your nonprofit.
Yeah, no, really great points. And I wasn't even thinking about, kind of that debt financing that people went into with the PPP loans. So just found it very interesting. And I think it's something that, like in 10 years might be the norm, being able to finance individually through funding, or even like these direct public offerings. Now that it's in this, nonprofit sphere, we'll see that more, especially in larger nonprofits. But yeah, found it really interesting. Mark, do you have our next article for us?
I do. AJ, you're going to love this one. This is this is a little bit of a challenging article, but I think sometimes it's important for us to bring up topics and different perspectives, other than our own, other than from two white guys in the room, right? But this one is called "The Racial Politics of Solidarity with Ukraine," and this is from Nonprofit Quarterly. And I think this article brings up some important points about the giving and the amount of giving to the people of Ukraine. And as the giving started happening, and as people the money started pouring in, the ability for refugees started to move across borders, and all sorts of support was going to Ukraine, which is great. And at the same time, it was outsized compared to other conflicts that we've seen in the world. And so this author posits that a large part of that is because the racial diversity and makeup of the Ukraine is that it's largely white Europeans. And, they give specific examples of different news programs, et cetera, where they're effectively dog whistles, racist dog whistles, talking about how, well, I can't imagine somebody with blue eyes and having to live in these kinds of squalid conditions and certain things like that. But when Afghanistan kind of all fell apart, the money wasn't quite there. The support wasn't quite there for the people of Afghanistan. Now, systemically, this appears to be the case. I'm not going to say that this was the goal of every single person who gave to Ukraine and didn't give to Afghanistan. That's not what I'm here to. The purpose of me bringing this article to the fore is because, as a nonprofit out there, assuming that you have some sort of affiliation with a nonprofit, if you are giving or you are supporting, you have to be aware of what the public persona is on what you're supporting to, right? If the banner on your web page all of a sudden says support Ukraine, but you never support any other causes, that might be completely innocuous on your part, but the perception might be different. So, you don't necessarily need to change your ways. I'm just bringing this to the fore to say, have awareness that you may be perceived a specific way if you're only giving to a specific kind of charity. And, I don't want to belabor the point, but I think the points made in this article, and of course we'll link to the articles, are great, because it's some things that I don't necessarily think about, right? And I think that's part of the problem, is if we're out there not thinking about the perception of our actions, it can be detrimental to us, and we don't even know why, right? So just have awareness, and I think that's enough said on that. AJ, you have some thoughts here?
Yeah. I'm wondering if, I had not, until reading this article, I had never thought of it that way. I guess it gave me a moment to pause and think like, okay, maybe we do view Ukraine as different from the support that was there and the financial kind of support that was there for Afghanistan or Iraq or Iran or any of those other kind of Middle Eastern countries that are, for lack of a better word, not European, of European descent. But I also might say that, I think this might be an overcorrection of, are we going to get to a point where nobody's going to want to do anything nice because they're afraid of the backlash from the other side? So I would say that support of the Ukrainian people, although, this might weigh into it, I don't think you should feel bad for your nonprofit or, your personal giving to support something like this, and I would say the same, towards anybody that, backed supporting, the people of Afghanistan or Iraq or any of that kind of thing. I think often, tribalism is real. And, if you're seeing people that look like you on the news and are in dire straits, that probably tugs at your heartstring. If we were a mostly, brown or black country or people of color, we might feel more apt to donate to Afghanistan or Iraq. I would just say that, I think, having context in it and just making sure that, you're presenting the type of support that is in line with what your mission and vision. If you're a school, a pre-K or, Head Start program, do you really need to have a support Ukraine banner up there? Or do you really need to take on every social cause that comes your way just to be in vogue and hopefully get social credit points of, hey, look, this is the new in vogue thing that we need to support, but also, not be blind and not see this kind of stuff. So I think it's a balancing act. And I think it's, spinning plates here where, you need to, of course, people are, daily we see issues and want to rally support behind something. And I would say, don't let, kind of the impact of, or the other side of that, dissuade you into supporting something that you really believe in, but also with the lens of realizing that it's not always as it looks, I guess as well.
Yeah, and I would, great points, AJ, and I would also suggest, right, the other side of this pendulum existed with the Black Lives Matter movement, right? Nonprofits were some that jumped right in, got pushback from those who didn't support Black Lives Matter, and you have to be aware that when you take a stand on either side, there is going to be a perception by your audience, whether it's a positive perception or a negative perception. you have to decide for yourself as a nonprofit, do you even want there to be a perception? Do you want to jump into the fray? You can still give to Black Lives Matter or the Ukrainian people without necessarily making it a cause, as AJ said, that doesn't have to necessarily do with anything with your mission. I mean, the other thing I would say that might counter this article a little bit is that in this Ukraine affair, the aggressors are also Anglo white people, right? So it's like you're supporting one group of refugees that look one way from an oppressor that is also looking the same way. So, you know, that would be me taking the racial politics out of this, but I'm not comparing Ukraine to Afghanistan in that case, of course. So, I don't want to. Yeah,
sorry, Mark. I was going to say, to use your example, right? I think what the article also missed, a lot of these people that are supporting Ukraine or whatever are probably the same people that were supporting Black Lives Matter. So to say that this is just, because they're white Anglo-Saxon looking people in Ukraine, that this is somehow inherently racist, that we didn't throw our support behind anything else. I would argue that the same people you see with those Ukrainian flags that are in support of Ukraine now are also vastly the same people that were supporting Black Lives Matter movement, to currently and for the last 2 years. So,
right.
Yeah, I don't know. I think the article definitely swings one way.
It does. And it's impossible to support everything, right?
Sure.
It's like you would spend your entire treasury and your entire time trying to support all causes just to be equitable. So, just have awareness. That's all. From that, let's move to today's topic, AJ.
Yeah, let's. So we have a question that comes in, a topic that we've talked about on the show before, but I think it's worth revisiting. So the question comes from a listener, and they say, I always hear about how nonprofit revenue sources should be diverse. How diverse, and what are some diversification, targets? Can you kind of break down what those chunks that I should be thinking about in diversification are, and how to go about like knowing whether or not my funding is diverse in the first place? So, I have, we've talked about this on the podcast before, and I have some, I guess, back of the napkin sketches on this. But Mark, I'll let you jump in first and maybe talk about what we mean by diverse revenue sources, and maybe, those pieces of the pie, if we were looking at a pie chart of how your organization should be split up as far as fundraising sources or revenue sources come from.
Sure. Yeah, right. Diversification, usually when you're starting out in a nonprofit, a lot of your money is just coming from individual donations, or if you're funded by a grant, it might be coming from one large grant source, right? So the idea of diversification is, as you grow and as you expand, you want to start bringing in money from a lot of different types of revenue streams so that you're not dependent wholly on, this one grant or something like that. So some revenue streams could be, giving by individuals is a huge one, right? You could have foundations, you can have grants, you could have corporate sponsorships, you can have bequests, you could have fundraising events. AJ's absolute favorite fundraising events, because we know they're the big piece of the pie. Just kidding. And then you just basically want to be diverse in these different revenue streams, and you can get creative. I think the general rule is that you don't want to have 20% of your income come from more than one source besides individual giving, because individual giving, that's diverse in and of itself because there's lots of different individuals. I think the other general rule I would just add in here is that if you have a reserved budget for grants or foundations, you don't want that all coming from one source, right? Because if you're budgeting for $100,000 in grant money, and that is all coming from a $100,000 grant, if that grantor goes away, all of a sudden your grant revenue goes down to zero. So, that's that diversification within the categories as well. So AJ, why don't you jump in and give us some more?
Well, and so I'm actually glad, that we're talking about this, because I think context matters, and what Mark just said totally resonates. I mean, if you have, let's say if 50% of your organization relies on, donations, but then all your donations come from like two people, that's not very diverse, as opposed to if there were a lot of small, like thousands of small gifts that made up that fundraising total. And same thing goes for grants, right? If your organization is supported 100% by grants and like contracts with governmental agencies, it makes a big difference if you have 30 different grants from 30 different, counties, states, federal sources or whatever, as opposed to all grants from one source. And the reason why I say that is you may have a county, there's a nonprofit I work with that has 15 years of a city contract that has been the main driver of their organization over the last 15 years. And that contract is going away. And, like it's cause for concern. Although they have a diverse revenue stream, this is a major part of what they do and a major part of their funding source. So much so that there's a concentration footnote in their financial statements that says so, that almost 40% of their funding comes from this one source. And without it, they're really at a loss, and they're going to have to make up a lot of ground through diversifying their revenue streams. And so even though they have a diverse stream, it's not going to mean the end of the nonprofit. They really are between a rock and a hard place here because of the need and the reliance that they had grown accustomed to over the last 15 years. I worked with, I had a partner at the CPA firm that I was working at previously. She was on the board of a nonprofit, and she constantly was telling them how this one grant that they received year after year after year after year from a certain foundation needed to be looked at, and they needed to diversify, and what would happen if they ever lost that funding. Well, surprise, surprise, they lost that funding. There was a change of board at that foundation, and that grant went away. And it was probably 50% of what they, used in their budget and what their revenue source was from. So overextending yourself, concentration, I think, is key in each one of these, sectors of Mark, that piece of the pie that Mark laid out. Not just concentrated, in that pie slice, but within each one of those areas, understanding what the diversification is in funding sources, and I guess looking at your diverse grants, fundraising, donations, all the different sources that you have. You could be diverse, but if you only have one or two people or organizations that are giving in each one of those areas, you're overextended in each one of those areas. So I think that's probably the most important thing to think about is continuing to have diverse revenue streams, meaning even in the grant section, you get more grants from different agencies than the one you're just currently granted with or contracted with. So
that's and AJ, I should also throw in investments. I completely forgot that is the revenue sector, right? Because you might have some permanent funds that are sitting there that aren't being touched, but that are earning you big investment bucks. So, everybody understands the idea of diversification within a portfolio, but they don't necessarily understand diversification within revenue streams.
And I think that's a great point. Even in your investments, right? Are you, like looking at those how that investment portfolio is made up? Is it just sitting in a savings account earning $2 a month? Like that's not a very good use of your investment dollars. If you can stand to put them in something that would have a higher return, like that should be looked at, and looking, if you're lucky enough to have an endowment that brings in a decent chunk of money from your investment return, looking at how that endowment is invested, if you can look at that, or understanding how it's invested and with the organization that you've placed that money with, is vital. And I think understanding that from your budgeting standpoint and from your organizational standpoint goes a long way in not creating big swings in revenue and not over relying on a couple sources,
Totally agree. And I think just to put a bow on this, it's never too late to change your diversification plan, right? Just get out there with your budgeting system. And when you're creating the next annual budget, start looking to increase other revenue streams and focus on that. You don't have to do it all at once, but you can start saying, well, how do we bring in more of these kinds of revenue streams, and how can we grow that? How do we create an endowment? How do we get, more major donor gifts, whatever that looks like for your organization, wherever you're lacking. Keep tweaking at it, and eventually you will get to a pretty diverse stream where the risk to the organization's your going concern, if you will, is lessened by the fact that you have revenue coming, that if something drops off, you're not in dire straits. So I think that'll do it for another episode 50 of Profitless on Purpose. We certainly appreciate you being with us and being on this journey with us. It's been a good ride so far. On behalf of AJ and myself, thank you so much. Of course, you can reach out to us on Twitter at ProfitlessPod, or leave us some comments down below on the YouTube video. And, on behalf of AJ and myself, thanks so much. See you for the next
everybody.
50.
To another 50.
Yeah.